All right, let's get into it. Today, we're going to crack the code on a number that, let's be honest, can feel super mysterious, but is also crazy important for your financial life. I'm talking about your FICO score. So let's pull back the curtain and figure this thing out once and for all. And you know what? That's so true. This one little number has a ton of power. I mean, it can decide whether you get that awesome apartment, what interest rate you'll pay for a new car. It even affects how much you pay for car insurance. It really is your financial passport. Just think about it like this. Your score is kind of like the gatekeeper to some of your biggest life goals. A great score, it opens all the doors. A not so great one, well, it can slam them right in your face. So, how in the world is this super important number even calculated? That's exactly what we're here to do. I'm going to show you the exact blueprint, the secret recipe behind your FICO score. And why FICO? Why this specific score? Because a whopping 90%, that's right, 90% of top lenders use this model to make decisions about you. So yeah, if you're going to play the game, you've got to know the rules. And FICO, they basically wrote the rulebook. And here it is, the whole secret formula, laid out right in front of us. No more guessing. These 5 things are what make or break your score. Let's really dig into what each one of these pieces means. First up, the absolute heavyweight champion of your credit score, your payment history. It's 35%. That makes it the single most important factor. Lenders want to see one thing above everything else. You pay your bills on time every single time. And you do not want to mess this one up. The penalty is, well, it's severe. Get this. Just one payment that's 30 days late can potentially drop an excellent credit score by up to 100 points. 100! That is a huge hit from a single slip-up. So yeah, always pay on time. All right, coming in hot at number 2, making up 30% of your score, is amounts owed. Now, hold on. This isn't just about how much debt you have in total. It's about something way more specific called credit utilization. Basically, it's the ratio of what you owe on your credit cards versus how much credit you have available. And this is the key. To really crush this part of your score, you want to keep your utilization super low. All the experts say to keep it under 10% for the best results. Think about it. Using just a tiny bit of your available credit tells lenders you're responsible, not that you're in over your head. Now let's knock out the final 3 pieces of the puzzle. Together, there's still a third of your score, so they matter. First, at 15%, is the length of your credit history. The longer, the better. A long, steady history shows you're reliable. That's why you should never close your oldest credit card, especially if it doesn't have an annual fee. Next up, at 10%, is your credit mix. This sounds complicated, but it's not. It just means lenders like to see you can handle different kinds of debt. Like credit cards and installment loans like a car payment or student loan. And last but not least, the final 10% is new credit. This is all about how often you apply for stuff. Too many hard inquiries in a short time can look like a red flag. So, maybe don't apply for 3 different store cards in one trip to the mall. Okay, so now you know the formula, but what about the hidden traps? The stuff that can sneak up and wreck all your hard work. Yep, there are silent score killers out there. Let's talk about how to spot them and avoid them. 2 of the biggest villains here are identity theft and, you guessed it, those forgotten bills that end up in collections. This is why it's absolutely crucial, I can't stress this enough, to check your credit report regularly. You can do it for free with services like Credit Karma or at annualcreditreport.com. And let's be real, it happens to the best of us, right? A medical bill gets lost, an old cable bill goes to the wrong address, but even a tiny forgotten $50 bill can end up in collections and stick to your report like glue for 7 long years. So you gotta stay on top of it. Okay, enough with the scary stuff. Let's switch gears and talk about being proactive, how you can actually build an awesome score. I'm going to give you some real pro-level strategies you can start using like today. So here are 3 powerhouse plays. First is the authorized user hack. This is where you get someone with amazing credit, like a parent, to add you to one of their old cards. Their great history can give your score a serious lift. Second, and this is so simple, call your credit card company and ask for a limit increase. Poof! A higher limit instantly drops your credit utilization ratio. And third, you gotta master the 15/3 rule. What's that? Well, see, most banks only report your balance once a month. So if you make one payment on the 15th and another one about 3 days before your statement closes, you make sure the balance they report is always teeny tiny. It's a game changer. So, why are we doing all this? I mean, why go to all this trouble for a number? Well, the answer is simple, and you can measure it in cold, hard cash. A lot of it. And this right here shows you the real-world difference. Just look at this mortgage example. Someone with an excellent 780 score might get an interest rate around 4%. Awesome. But someone with a fair 620 score, they could be looking at 7%. Now, 3% might not sound like a huge deal, but over 30 years, it's a financial earthquake. That difference in interest could easily cost the person with a lower score over $100,000 in extra interest payments. Let that number sink in for a second. A better score isn't just about bragging rights. It's a $100,000 savings account. So look, the power is totally in your hands now. You have the blueprint, you've got the strategies. The only question left is, what are you going to do about it? I'm telling you, take one small step tonight, just one. Go download your credit report, look for stuff that's wrong, and fight it. Your future self is going to thank you. Big time.